Morning, good afternoon, or whichever time you're watching this video clip. Now, welcome back to Management Accounting. Now, we're going to look at non-discounted cash flow techniques. Non-discounting cash flow te- non-discounting techniques ignores the time value of money. Although most companies use DCF models to make capital budgeting decisions, some companies still use simpler models, either in place of or in addition to NPV model. What is the accounting rate of return? The accounting rate of return is the percentage rate of return expected on an investment or asset as compared to the initial investment cost. ARR divides the average revenue from an asset by the company's initial investment to arrive. ARR divides the average revenue from an asset by the company's initial investment, which is no. ARR divides the average revenue from an asset that is inflow inflow by the company's initial investment, that is what outflow, to derive the ratio or return that can be expected over the lifetime of the cost, over the lifetime of the asset or related project. Again, the accounting rate of return is the percentage rate of return expected on an investment or asset as compared to the initial investment cost. Alright? ARR divides the so is the percentage rate of return expected on an investment or asset as compared to the initial investment cost. That is, ARR does not consider the time value of money or cash flows, which can be an integral part of maintaining a business. ARR, one formula for ARR is ARR equal average annual profit divided by what? Initial investment. So therefore, in calculating ARR, you don't need to have any scrap value. Alright? How to calculate the accounting rate of return? Now, calculate the annual net profit from the investment, which could include revenue minus any annual costs or expenses of implementing the project or investment. If the investment is a fixed asset such as property, plant, or equipment, subtract any depreciation expense from the annual revenue to achieve the annual net profit. Divide the annual net profit by the initial cost of the asset or investment. The result of the calculation will yield a decimal. Multiply the result by 100 to show the percentage return as a whole number. That's how you do ARR. Alright. We're going to look at the examples later on. What does ARR tell you? The accounting rate of return is a capital budgeting metric useful for a quick calculation of an investment's profitability. ARR is used mainly as a general comparison between multiple projects to determine the expected rate of return from each project. ARR can be used when deciding on an investment or an acquisition. It factors in any possible annual expenses or depreciation expense that is associated with the project. Depreciation is an accounting process whereby the cost of a fixed asset is spread out or expensed annually during the useful life of the asset. Depreciation is a helpful accounting convention that allows companies not to have to expense the entire cost of a large purchase in year one, thus allowing the company to earn a profit from the asset right away. Even in its first year of service, in the ARR calculation, depreciation expense and any annual cost must be subtracted from annual revenue to yield the annual what? Net profit. What is he saying to us that this part now, if there is no cost or expenses, you just simply do revenue. Average annual profit is revenue. Alright? Just note that please. ARR is helpful in determining the annual percentage rate of return of a project. Key takeaways for ARR. ARR can be used when considering multiple projects since it provides the expected rate of return from each project. However, ARR does not differentiate between investments that yield different cash flows over the lifetime of the project. Example of how to use the accounting rate of return. A project is being considered that has initial investment of $250,000. It's an example of how we use accounting rate of return. It is forecasted to generate revenue for the next 5 years below next 5 years. Below are the details. Initial investment is what? 250,000. Expected revenue per year is what? 70,000, right? Time frame is 5 years. Watch this now, Jenny folks. Now this 70,000 is like your what? Inflow. The 250,000 is your what? Initial investment or initial cost. The ARR calculation now would be what? The 70,000 for the 5 years, right? Divided by $250,000. Now, the for the calculation here, what you should do really, so now by right, let's give an idea now. This 70,000 that you have here, right, is the annual revenue, no, so average annual revenue. Now, if you multiply 70,000 by 5, because it's a time amount of time, you get 350,000, right? And to find the average of it, divide it by 5 again. If you divide 350,000 by, if you divide 3, so I'm saying again, you multiply 70,000 by 5, you get what? 350,000, right? Now, this 70,000 is like your initial, every year you earn what? 70,000. Good? For the 5 years. So at the end of the 5 years, you'd have a revenue of what? 350,000. Because you earn 70,000 every year. Now, remember that our instruction up top was that you what? You should be have your annual, average annual profit. Good? Now to get the average annual profit in this case now, which would be revenue alone, you'd have to now divide the 350,000 by 5, and that's where you get the what? 70,000. And you divide the 70,000 now by the what? Initial cost, which is 250,000, and you would have gotten 0.28. Then multiply by 100 to get what? 28%. The difference between ARR and RRR, we're going to go to now. As stated, the ARR is the annual percentage return. Now, just for argument's sake, folks, imagine now, you might see it very soon, but imagine you have your initial cash flow, right? So you have 100,000, and you have 1, 2, 3, 4 different years of revenue, of initial of inflows, right? Those are considered to be a revenue. To find your average annual profit, what you do is add up those divided by the amount of years that you have there. Which would have been in this, which would have been in that case about 4 years, for argument's sake. Alright? So, and then you would go ahead and calculate. You will soon see an example later on. Now, the difference between ARR and RRR. As stated, the ARR is the annual percentage return from an investment based on its initial outlay of cash. However, the required rate of return, also known as the hurdle rate, is the minimum return an investor will accept for an investment or project that compensates them for a given level of risk. RRR can vary between investors because investors have different risk tolerances. For example, a risk averse investor would likely require a higher rate of return from an investment to compensate for any risk from the investment. It is important to utilize multiple financial metrics, including ARR and RRR, in determining if an investment is worth it. With limitations of using the accounting rate of return now. Limitations. One, the ARR is helpful is helpful in determining the annual percentage rate of return of a project. However, the calculation has its limitations. ARR doesn't consider the time value of money. The time value of money is a concept that money available at the present time is worth more than an identical sum in the future due to its potential earning capacity. In other words, two investments might yield uneven annual revenue streams. If one project returns more revenue in the early years and the other project returns revenue in the later years, ARR does not assign a higher value to the project that returns profits sooner, which could be reinvested to earn more money. The accounting rate of return does not consider the increased risk of long-term projects and the increased uncertainty associated with long periods. Also, next one is that if one if one project returns one more revenue in the early years and the other project revenue in the later years, AR is that assign a higher value to the project that returns profit sooner, which could be reinvested to earn more money. The account rate of return does not consider the increased risk of long-term projects and the increased uncertainty associated with long periods. Also, ARR does not take into account the impact of cash flow timing. Let us say an investor is considering a 5-year investment with an initial outlay of $50,000, but the investment doesn't yield any revenue until the fourth and fifth year. The investor would need to be able to withstand the first 3 years without any positive cash flow from the project. The ARR calculation would not factor in a lack of cash flow in the first 3 years. ARR formula now, the formula for ARR is what? Average annual profit divided by what? Average investment. Should have been initial investment, sorry. No, this is the second formula that you can use, that is, I should say. The second formula that you can use, average annual profit divided by what? Average investment. Now, to find this part now, average investment is equal to what? Book value at year one plus what? Book value at the end of useful life divided by 2. So there are two different formulas which you can use to calculate average rate of return. This one, and you have this one, which is the simplest ones. Simplest one, this one, alright? Don't forget that, please. Average annual profit equal total profit over investment period divided by what? Number of years. To learn more, launch components of accounting rate of return now. If the ARR is equal to 5%, this means that the project is expected to earn 5 cents for every dollar invested per year. In terms of decision making, if the ARR is equal to or greater than the required rate of return, the project is accepted because the company will earn at least the required rate of return. If the ARR is less than the required rate of return, the project is what should be rejected. Therefore, the higher the ARR, the more profitable the investment. Alright. We'll look at, before we go to payback model, let's take a little look further of more detail at ARR. Alright, let's go to payback model now, which is the second the other discounted cash flow technique. Non-discounted, right? Discounted is where you use the time value of money. Non-discounted is where you ignore time value of money. Alright. Payback time or payback period is the time it will take to recoup in the form of undiscounted cash flows from operations. The initial dollars invested in a project. Alright. So the amount of time you will get back the amount of money you invest in the project basically. Alright. Assume that Toyota spends $12,000 for forklift that has been estimated useful life of that's an estimated useful life of 4 years. What this means is that this is the initial investment, right? Toyota expects the new forklift to reduce cash outflows by $4,000 each year. The payback period of 3 years calculated as follows. Now, payback time is equal to what? Initial incremental amount invested divided by equal annual incremental cash inflow from operations. Alright. Let's look at the calculations now. So it's really I equal O. So the in this case now to be the initial incremental amount invested divided by what equal annual incremental cash inflow from operations. This is just the simplest part of it, my friends. The other parts, I'll show you another example shortly, which is more difficult. So simply divide the 12,000 by the 4,000, you get what? 3 years. Alright. We can use this formula for the payback time only. Sorry, we can use this formula for payback time only when there are equal annual cash flows from operations. When annual cash flows are not equal, we must add up each year's net cash inflows until the point in time where the cumulative cash flows add up to the amount of the initial investment. Follow me? So if you have different cash flows, you must add everything must add up until you reach a point where you reach what? In this case, $12,000. Alright? As it says, see capital budgeting document for the other method of calculating payback period. We're gonna go to it now. See it right there. Now, payback period of an investment tells us the number of years required to recover the initial cash investment. It is the ratio of initial fixed investment over annual cash inflows. Look at this one, 5,000 per year for 5 years, and that will give you 3.16 years, right? If the annual cash inflows are not equal, calculations are more difficult. If the cash flow is, for example, look at this now. You have 18,000 first. Good. What they are trying to do now, you are trying to reach the point where you are at the point where you, and out of everything, you reach back to 18,000. Alright. Now in the same year that you reach 18,000 when you stop. Is it possible? Good. Let's look at it now. So inflow of 49 would have reduced the initial cash inflow to what? 31 to 100. 5,500. What does that mean here? Subtract 49 from 18 to get 13,100. Then you subtract 5 from 30,100 to get what? 7,600. Subtract 5,700 from 7,600 to get what? 1,900. Now, when you reach the point, now when you realize that you cannot subtract the other year amount, the other initial investment from the last amount, that's when you stop. Good? You stop right there. What that means is that what this really means is that your your initial investment would have been cleared up by year four or in year four then. So you would stop at year four in this case. Alright? So once you cannot subtract this figure from the last figure, you stop right there. When you reach on here now, you're going to divide the last figure by the current year. Alright? Good? Then now, watch this carefully. You're gonna see. So that means that you would have paid back in 1, 2, 3 plus some of the fourth year. So it is in the fourth year that the thing is really finished. Let me go again one more time. First thing is first. Subtract 49 from what? 18,000. You get what? You subtract the first the first what call it? The first inflow from the initial investment. Should be 49 from 18,000 get 13,100. 5 now. From 13,100 get what? 76. 7 from 76 get 1,900. Now you realize that you can't subtract 62 from 19, right? You stop right there. Then now, the balance that you have from the third year, you're going to divide that figure. Sorry, you're going to divide that figure now by the current year. By the inflow of the current year, which is 62 in this case, and then you get what? 0.31. Then now you're gonna add 0.31 to the what? First 3 years. So they end up for this now, the payback period is what? 3.3 years. Now the total cash inflow is the same 28,500, but now the payback period is what? 3.31 years. Alright? Now the shortcomings of payback now is that if it fails to consider cash flows after the payback period, therefore it cannot be regarded as a measure of profitability. It does not take account of magnitude or timing of cash flows during the payback period. It does afford management limited insight into the risk and liquidity of a project, since the shorter the payback period, presumably less risky and greater its liquidity. But these should be more appropriately Bush, these should be more appropriately, but these should more appropriately be treated as constraint to be satisfied, not as profitability measured to be maximized. Thank you very much for watching this video clip. Just focus right here, go back to here and look at what I did. This is a critical point. When you reach the point where you cannot subtract from the cumulative cash flow amount, you know that that's where you stop it. Then what this is saying that you would have paid off in the fourth year. You'd have covered the expenses in the fourth year basically. You'd have covered the initial investment then, I should say, in the fourth year. Alright? That's how this is saying. So thank you very much for watching the video clip. You should pause the video, write the information down, and wish you all the best in completing your assignment. Thank you very much. Enjoy the rest of your night and day.